Let's get analysis now with Robert Heller. He is a former Federal Reserve governor. He joins us live now from San Francisco. Governor, thank you so much for your time. Thank you for breaking this all down for us. So let's begin on what we've heard overnight. Chair Powell ultimately conceding that inflation has surprised to the upside. So in your view, sir, do you think this 75 basis point hike is going to go far enough to address that challenge?
Absolutely not, because inflation will continue to rise and the Fed is still way behind the curve. If you look at the current Fed funds rate in real terms, it is still stimulative. It has a negative real rate. So we are still pushing inflation higher than it was before.
So let's talk about the guidance that the Fed has offered, 50 or 75 basis points again in July. How soon before we see clear evidence that inflation is starting to abate in the United States? And is it going to take a recession to get there? That is the big fear in the markets right now.
Well, we are very close to a recession as it is right now. In the first quarter of this year, we already had a slight downturn in GDP. And if you look at the GDP now data from the Atlanta Federal Reserve Bank, which looks at actual data and forecasts on the basis of the actual data, they are forecasting right now exactly a zero GDP for the second quarter, for the current quarter. So you have 1 quarter of negative growth and 1 quarter of no growth. A recession typically is defined as 2 quarters of negative growth. We are perilously close to that because we are looking at a zero growth for the second quarter. The smallest negative influence will tip us actually into a technical recession.
Robert, it's Hadley in Dubai. I mean, this is something that you're very familiar with, the importance of messaging. How would you grade the Fed in their messaging at this point?
Well, when I was at the Fed, there was no messaging. The Fed would just present facts and let the market guess what was happening. There were lots of Fed watchers in New York who got paid for trying to figure out what the Fed actually had done. Now the Federal Reserve tries to message, and the messages tend to be wrong all the time. There wasn't any message to have a 0.75% increase in the Fed funds rate. You see now that all the Fed FOMC members, they're all starting to increase their projections because they saw that the last projections were too low. I think by making these projections, this guidance to the market, I think the Fed really endangers its own credibility because they are not making policy, they're making forecasts. And they're not supposed to be forecasters. They're supposed to be policymakers, and they should stick to their knitting.
Yeah. I wonder about this in future. I mean, when we're talking about a bear market, when we're talking about how worried people are, we've been running stories all day about this new psychology, essentially, which is this sort of need to get in there before the rates change, you know, for homeowners and this kind of thing. How damaging do you think that this is for folks sitting in the United States specifically at this point in terms of their willingness to go out there and put money in the market, to go out there and buy? I mean, what are we going to see in the next CPI round, do you think?
Well, the next CPI round, Hadley, we will see further increases in the inflation rate. I think towards the end of the year, we will be looking at 10% consumer price index increases instead of the 8.5% that we are looking now. So the news will be made by the market, and the Federal Reserve doesn't have to scare the markets ahead of time. The markets themselves have already priced in an enormous slowdown. We're in a bear market right now, roughly 20% down from its peak. So the recession that I would think is coming is already priced in, if you want to say so, in many market measures. And that may be for the good, because once the recession arrives, then we say, well, it wasn't 20% down, so we can start buying again. So I think the Federal Reserve should just let the economy play out, watch the own variables that are under their control, like the money supply, something that they don't talk about at all, It's still growing at 8.5% year over year. It's down from 25% last year and the year before. So that is a very good move. The Fed is on the right track. Money supply is not growing as fast as it was growing in the past. And I think eventually that will have its effect. But from 8.5, we still got to go down to a range around 5%. So we got a ways to go.
Governor, I also wanted to just pick up on a point you made before, going back to credibility and the messaging that we have heard from the Fed. Chair Powell has been criticised in the past for being well behind the curve. He was late to hike, and of course they got the call on transitory inflation very wrong as well. Can you trust this Federal Reserve and this Federal Reserve Governor on the economic projections moving forward and the rate projections moving forward as well? Because while we're seeing relief in the markets today, there's skepticism out there that this Fed has the credibility it needs to guide markets and rates through the course that they need to in order to tame this major inflation problem. And we know this is also an issue, not just for the Fed, but also for the White House, particularly when it comes to President Biden's prospects in the midterms and a second term overall. Your view?
I think you put your finger right on the issues that are confronting the United States. Your points are very, very well taken. And that's why I'm saying the Federal Reserve should not put its credibility on the line by making forecasts of what they will be doing half a year from now. Instead, they should just be watching the data, react to the data, look forward in time, see what will happen, but don't make forecasts as to what your policy changes will be that will be required because of these ever-changing economic circumstances. You can't get it right all the time, and if you got it wrong, you got egg in your face.
I also wanted to just pick up on the political angle as well. What is at stake for President Biden if the US is not able to tame this inflation challenge?
Well, a lot is at stake. You saw what happened in the 1970s and the 1980s. We had 2 recessions in a row because inflation got out of control. There was a wage price spiral, like Hadley was talking about earlier. People will buy things early in anticipation of bad things to come, of prices rising further. And once that inflationary psychology takes hold, like it does right now in the United States, you are in trouble because then you're chasing your own shadow, and you've got to get ahead of that. You remember what it took in 1980 to break the back of the US inflation at that time? The Fed funds rate at the end of 1980, most people will not remember, it was 22% Fed funds. And that eventually broke the back of the inflation. And as a result, we had 30, 40 years of price stability. And you should not squander these hard-gained effects, these hard-gained accomplishments by giving up on inflation. You got to fight it. You got to have price stability. Price stability, in my book, means not a continued 2% inflation, but really prices equal as close to zero as possible.
Robert, we're going to have to leave it there. I have to tell you, it's a great day for me when I realized that both Dan and I don't actually remember 1980. 1981, baby. Robert, we're going to leave it there. Thanks so much for joining us today.
Pleasure, Hadley. Thanks.
Well, coming up on the program, we're going to continue to gauge reaction to the Fed decision across the Asian session. We're going to check in on the market action after this quick break. Stick with us.